Did you know that your money is silently losing its value by sitting in a checking account? Surprising, isn't it? Greetings, my friends. I am Albus Wealthmore, and today we'll embark on an enlightening journey through the basics of investing. Together, we'll explore how your savings erode over time, the primary investments you can buy, the risks involved, the best time to invest, and much more. As a beginner, investing can be intimidating and complicated, but it does not have to be this way. And it is essential that you learn the basics of money and investing if you wish to one day have a pile of wealth to your name. First, let's conquer the concepts of saving money and inflation. Saving involves setting money aside for things like an emergency fund or a down payment on a new home. However, if the interest on your savings is lower than inflation, you may lose purchasing power over time. Let me explain this last part step by step. Depositing money in a savings account earns interest, which is a small profit you receive for keeping your money with the bank. For example, earning 2% annual interest on a $1,000 deposit earns $20 in the first year, enough to buy a burrito, but not much more. Inflation, on the other hand, is the increase in prices of goods and services in an economy, including items like food, gas, and rent. If the rate of inflation surpasses the rate of growth on your savings, your purchasing power or ability to buy things declines. Consider this example. With 5% annual inflation, a $1,000 basket of goods and services will cost $1,050 in a year. If your savings account earns 2% annually, your $1,000 deposit grows to $1,020 in a year. In this scenario, the prices of things you need to buy are growing faster than your money, meaning your money can buy less over time. The lesson here is that inflation erodes the value of your money, and over many years, it can lead to significant or total loss of value. It's like a dark spell that inflicts damage to your wealth over time. Which brings us to investing. To build wealth and maintain our ability to buy things, we need to grow our money at a rate faster than inflation. In 2023, this means venturing beyond the realm of savings accounts, which offer low interest rates relative to today's high inflation. The US government and media refer to the Consumer Price Index, or CPI, when talking about inflation in the United States. In February of 2023, the CPI was at 6%, meaning the prices of various goods and services rose 6% over the past year. Inflation is not constant, so it will change. But 6% inflation in the United States means investors need to grow their money at 6% or more over the past year to protect their purchasing power. Knowing investing is the only way to defeat the dark curse of high inflation. What can you invest in? Let's adventure into the world of places and assets that people put their money, arranged from low risk to high risk. First, high-yield savings accounts. As of March 2023, high-yield savings accounts are earning 3 to 4%, which is a decent risk-free return on your money. A benefit of high-yield savings accounts is FDIC insurance, which means balances less than $250,000 are fully backed by the US government, allowing you to fall into a deep slumber at night. Even with inflation at 6%, earning 3 to 4% reduces the loss of your purchasing power to 2 to 3% per year, which is better than the 6% loss you'd experience with your money parked in a checking account or buried in your backyard. A high-yield savings account would be a good place for those who wish to earn a small return on their money, have easy access to their cash, and maintain high sleep quality with FDIC insurance. My friends, the next investment class you can invest in is bonds. The safest bonds to invest in are those issued by the US government, which are called US Treasuries. Investing in US Treasuries is akin to lending your money to the US government. In exchange, you receive regular interest payments and the return of your initial investment upon the bond's maturity or expiration. Fear not, for U.S. Treasuries are considered risk-free, as the government's backing ensures a stable means of safeguarding your wealth while earning a return. Currently, a one-year U.S. Treasury bill has a yield of about 4.5%. This means if you bought $1,000 worth of these Treasury bills, you would have a final balance of $1,045 when the Treasury bill matures in a year's time. You can then reinvest your $1,045 into another U.S. Treasury position at the yields available in a year's time. Even with an expertise in magic, I do not currently have any spells that reliably predict the future, so I cannot inform you of what U.S. Treasury yields will be in a year's time. Well, I do know some spells and elixirs that claim to offer such an ability, but so far the results have been unstable, to say the least. Anyways, U.S. Treasuries are popular among high net worth investors, as the market for them is truly massive. According to SIFMA, the size of the U.S. Treasury market was $24 trillion as of the fourth quarter in 2022. This means a single investor could park tens, even hundreds of millions of dollars in U.S. Treasuries, which would be a much safer position than holding such a vast sum of money in a checking account with only $250,000 in FDIC insurance. Another investment option is I-bonds, which are designed to protect investors against inflation. I-bonds can earn a fixed rate of interest in addition to a variable rate based on inflation, which is reset twice per year. Currently, the rate you earn with I-bonds is 6.89%, which is a fantastic return you can earn risk-free as it's backed by the US government. However, you can only invest $10,000 per calendar year into I-bonds, which is insignificant for those looking to protect substantial wealth. To invest directly in U.S. Treasuries and I-bonds, you'll need to set up a Treasury Direct account. Let us now delve into the realm of stock investing. Stocks, my fellow investors, represent part ownership of a company. By acquiring shares of a company, you partake in the company's fortunes, growth, and sometimes losses. Stock investing is an exciting activity with the potential for notable returns over time. Investing in flourishing businesses allows you to share in their prosperity and possibly earn dividends, which are a distribution of profits sent directly to shareholders each quarter. And stock investments can help you grow your money at a rate that outpaces the dark force of inflation. As an example of a stock investment, buying shares of Apple grants you partial ownership of Apple, and your investment in the shares will fluctuate with the company's worth. If Apple flourishes or falters, your investment will too. As of now, Apple shares have soared by 27% in 2023, a remarkable return compared to savings accounts and bonds. However, they've lost 10% over the past year, revealing the risks of stock investing. If you wish to avoid the time and headache of hand-picking companies, consider buying shares of exchange-traded funds or ETFs, such as VOO, the Vanguard S&P 500 ETF. The Vanguard S&P 500 ETF tracks a diversified portfolio of the 500 largest companies in the United States. By investing in VOO, you'll own a tiny fragment of each S&P 500 company, and your investment will mirror the returns of the index. By owning pieces of 500 companies, you gain the benefit of diversification, which shields you from significant losses due to one company's downfall. As of now, one share of VOO costs $365, granting you access to a well-diversified stock portfolio of 500 U.S. companies with just $365. To invest in stocks on your own, you'll need to open an account with a brokerage firm such as Fidelity, E-Trade, Robinhood, TD Ameritrade, Tastytrade, or Webull, to name a few popular options. If you wish to invest in low-cost ETFs with little to no brainpower, consider platforms like Wealthfront or SoFi Automated Investing. My friends, always remember that investing comes with risk. While it is true that we often need to invest our money in risk assets to defeat the force of inflation, it is possible to lose more money than inflation when investing in risk assets like stocks and cryptocurrencies. For instance, the S&P 500 experienced a loss of over 50% during the Great Financial Crisis, which is far worse than losing a few percentage points of purchasing power when sitting in cash. While a 50% loss is hard to stomach, those who held on for the long term and even purchased more during the crash eventually recovered all of their losses. There are 3 strategies you can use to minimize your potential for losses when investing in stocks. The first strategy is diversification, which is spreading your investments across various assets. For example, you might divide your portfolio between cash and savings, bonds, stocks, and crypto, reducing your overall risk by not putting all of your hard-earned treasures into one position. As a general rule, the younger and less wealthy you are, the more you can afford to take on riskier investments in pursuit of faster growth. Conversely, the older and wealthier you become, the more you should focus on diversification to protect your wealth. For instance, a young and thrill-seeking investor might choose to invest a majority of their money in high-growth technology companies, which could turn out to be a lucrative strategy if the companies multiply their profits. But an older, wealthier investor should be more conservative and diversify their money to avoid losing substantial portions of their wealth before retirement. Of course, investing is personal, and investors of all ages and levels of wealth can diversify as much or as little as they please. It all depends on your risk tolerance and goals. The second strategy to minimize your potential for losses when investing in stocks, specifically a stock market index like the S&P 500, is to hold on long term. As I mentioned, an investor in an S&P 500 fund saw their portfolio fall over 50% during the Great Financial Crisis. But if they held until today, they would have recovered all of their losses many times over. Thus, you should only consider investing in stocks if you are willing and able to hold those positions for many years. The third strategy to reduce your potential of losing money when investing in risk assets like stocks is to have an emergency savings fund. By having 6 months or more of expenses in cash or savings, you can avoid selling your stocks to come up with cash in a crisis. Without any emergency savings, you'd need to sell your assets to come up with cash in a crisis, which could mean selling stocks during a crash. So, by building an emergency savings fund, you can protect yourself from the mistake of selling stocks and other risk assets during a market crash, the time when well-prepared investors are snatching up assets at bargain prices. At this time, you might be wondering, Mr. Wealthmore, when is the best time to invest? Well, the best time to invest is, of course, at the bottom of asset price collapses, and the best time to sell is when they have reached the peak of a rally. But we do not have crystal balls or potions that allow us to see the future. As the great John Templeton once said, the best time to invest is when you have money. In other words, there's no perfect time to invest, and the sooner you begin, the more time your investments have to grow. When it comes to investment strategies, you can choose between lump sum investing and dollar cost averaging, DCA. Lump sum investing is when you dump a large chunk of money into investments at once. Dollar cost averaging is a practice of buying smaller amounts of investments in regular intervals over time. Lump sum investing would be best during the beginning of a bull market when asset prices are rising consistently, while dollar cost averaging is more advantageous during a bear market when prices are falling. In practice, it's natural to combine both strategies, since you'll gain more money to invest as you earn through your job. For instance, if you have $10,000 you want to invest right now, you could allocate the money into various assets all at once. Then, you can add small amounts to your investments each month as you earn more money. Another valuable quote from Mr. Buffett is, "Be greedy when others are fearful, and fearful when others are greedy." By this, he suggests we should buy more of our favorite assets when they are falling in value, such as buying more shares of the S&P 500 fund when the stock market crashes. If the market is crashing and you have available funds to invest, do not be afraid to snatch up shares of your favorite companies or ETFs at bargain prices. And when a market boom eventually comes, be wary of the greed that overruns the minds of investors, including your own. After substantial market increases, it is wise to be cautious about investing large sums in risky assets like stocks and perhaps sell some of your winners and shift the proceeds into lower-risk positions. Of course, the investment environment is always changing, which makes it difficult to provide advice that will guide you through every twist and turn. Let us proceed to the next important lesson on today's journey, which is about taxes. As an investor, it's crucial to understand the tax implications of your investments to keep yourself in good standing with your government. When you eventually sell profitable investments, you will be subject to capital gains taxes. Capital gains taxes fall into two categories: long-term and short-term. Long-term capital gains taxes apply to investments held for more than 1 year, while short-term capital gains taxes apply to investments held for less than 1 year. There are different tax rates for short-term and long-term capital gains. Short-term capital gains, or profits secured on an investment position held less than 1 year, are taxed at your ordinary income tax rate, which is often higher than the taxes you'd pay on long-term capital gains. Thus, it is often wise to hold investments for longer than 1 year to minimize your taxes on profitable holdings. In the 2023 tax year, the long-term capital gains tax is 0 to 20% depending on your income. If you earned less than $44,625, your long-term capital gains tax rate is 0%. And if you earned more than $492,000, you would pay 20% on long-term capital gains. You'll pay taxes on your net realized gains each year, which is a fancy way of saying the profits minus the losses from investments you sold that year. Any gains on investments you are still holding are considered unrealized or paper gains. When you sell those investments, you realize the gains and losses. For example, if you sold stocks for a $10,000 profit, but also had a $2,000 loss from another investment you sold, you would pay taxes on the net realized gain of $8,000. Assuming a 15% long-term capital gains tax rate, you should expect to pay $1,200 in taxes on the $8,000 gain. So don't go spending all that money on jet skis and margaritas at the beach club. The example here was simple, and taxes can be complex. So it's wise to seek out the help of a tax professional to ensure you minimize your tax burden each year. My fellow treasure seekers, we have traversed the mystical land of savings, inflation, investing motivations, asset classes, and investing risks. Remember, to truly amass wealth and overcome inflation's sinister forces, we must seek investments with growth potential exceeding that of inflation. But, as mentioned, it's also important to have a stash of emergency savings, preferably 6 months of expenses. Be wary of the risks when investing, and diversify your investments as a protective measure, especially if you have a low tolerance for losses. The investment opportunities that materialize before you shall shift constantly, so keep a watchful eye on the changes in inflation, savings and bond yields, the stock market, and government policy. Above all, continue to invest in your education on financial matters, as you cannot use knowledge you do not have to your advantage. I hope this lesson has heightened your investing knowledge and set you upon a path to building more fortune. I am Albus Wealthmore, and it's time for me to rest. I will see you in the next lesson.